thanks for jumping on. And I wanted to kind of get your take on the insurance industry kind of as a whole a little bit, just kind of a 30,000 foot view, and then we'll kind of go to maybe 10,000 foot and kind of stop from there. And then just kind of, let people know where to find you and how to get in contact with you and things like that. So without further ado, let's just introduce yourself. So who is Mark Kaplan?
Yeah, my name is Mark Kaplan. I'm a financial advisor and wealth creator at Compass Retirement Solutions, which if you've heard Marvin Mitchell, that's his company. So I've been in the business almost exactly 7 years now in the insurance industry. And it's one of those things I got in to help people. And the more you learn about it, the more you're like, man, there's some great things out here. And when it comes to insurance, people hear life insurance and they immediately think death insurance. And while there's reasons for term, and hey, I have term too, it has its place. I think what's really important is the life insurance, right? Building cash value through life insurance. There's so many great things about it. And most people, when I'm done talking with them, they're like, well, why haven't I heard this before? Never sat down and talked to somebody before, right? So, and that's really the truth. And I know we'll get more into it here in a second.
What actually made you get into the insurance space?
Yeah, good question. So I was actually in the fantasy sports industry before that. And I realized, A, I've always been good with numbers, but B, I was helping people win their teams or win their leagues and things like that. And I got a lot of joy out of that. So when things happened, I was like, all right, I was living in Memphis. That's where I'm from. A lot of my friends get married, having kids, and they didn't have anyone to go to for those type of things. And being the person I am, I'm like, well, this would be great if I could somehow help these people. And like I said, there's no one my age doing it. So I kind of got into it. And the more I got into it, the more I just loved it. And you're helping people every day. You never have to apologize for something you've done because in the end of the day, you're helping people.
A big part of why I do what I do is to be able to help people as well, and just kind of give them the information, give them the resources, and let them make great decisions for their financial future. For you, was pretty much the same. You were just starting to see kind of a gap in knowledge or access, and something that you felt like you could kind of bridge that gap a little bit.
Yeah, and like I remember my brother was having kids. We started talking. I was like, well, who do you go for this? He's like, I don't know. Who does my dad go for? I'm like, how is it? It's all older people doing this, right? It's not like I was just like, oh, here's the opportunity, but it takes the right person. I think people get the wrong name. It's in any industry, you can find bad apples, but you want to be the good apple.
Yeah, 100%. So for you then, like you mentioned earlier, like there's a lot of kind of myths, there's a lot of like kind of thoughts that are out there right now surrounding life insurance. They're thinking it's only for when you die and things like that. So what are some of like the biggest myths that you've seen, like being in this industry for almost a decade now, surrounding life insurance?
Yeah, I would say when people are like, buy term and invest the difference, right? We hear that a lot. And the first thing I tell people is, this isn't a get rich quick thing, right? When it comes to cash value life insurance, but especially Marvin's company, we're Compass Retirement Solutions. We deal with people that are retiring, that are going that phase of their life, and to see the amount of people that don't have long-term care, that don't have tax-free income, that don't have a life insurance policy. At that point, it could be too late to get it. But really, there's so many great things you can use it for. And I think that's what people miss out on because they immediately say, or hear life insurance, well, I don't want that. Well, you haven't even heard of what it does for you. Well, it's only going to go in my family when I pass away. Well, that's one type. But there's other types out there. And I think once they start hearing of all the different ways you can use it, it's one of the best vehicles out there, because unlike a 401k, which is not saying not to do, right? Especially get the match, that's free money. A lot of times you can touch that for 15.5, right? And if you want to use it, there's going to be penalties. When we can get tax-free growth that we can use, that's still going to grow even after we use it, there's really only one type of insurance, and that's permanent life insurance.
So that's one of the things for me that I was like, life insurance is really for when someone passes, when someone has to leave things for their kids and doesn't want to just leave the earth without having anything to provide for the ones that they're leaving behind. For you kind of mentioned it's not just about a death benefit. It's life insurance. It's for your life as well. Can you kind of go into that a little bit more?
So first, let's take someone around our age, maybe a little older, you're able to actually borrow from the cash value. When you borrow from the cash value, it's tax-free. You don't have to report his income. It's really up to you of how you want to pay it back. You don't necessarily have to pay it back. You can pay it back in lump sum. You can pay it back over time. If you never pay it back, it gets subtracted from the death benefit. Another great thing too is it's still going to grow as if you never touched it. What other vehicle out there can do that? Not really anything. So as you're accumulating other,
I don't mean to cut your wisdom here, but we gotta take an even further step back and go higher point view of here, because like people hear cash value, people hear being able to borrow from it and pay it back on your own terms and things like that. They're like, wait a second, whoa. So let's just talk about what is a whole life insurance policy.
So a whole life policy is a permanent insurance. So what I like to say is it's consistent, it's conservative. You're going to get a fixed rate of return with some dividends. So it's going to grow over time, right? And you still have access to it really after about 30 days, depending on how much you start putting in, you have access to it. You can borrow from it right away. So that's a great vehicle to have, something you're going to have the rest of your life. Again, it's going to grow it's going to grow conservatively. So expect that, right? But it's something that you have your whole life.
What's a reason why you would say most people that you deal with actually decide to go with a life insurance policy like this?
So with a whole life, it's because I think a couple different reasons. They just want, hey, I want conservative, I want consistent growth, I want want to make sure it's there. I don't want to have to worry about market fluctuation. Or some people say, hey, I have X amount sitting in the savings account. I don't want to sit in the savings account. I want to be able to have my dollar grow twice, right? Because if it's in the savings account, we use it, that really stops the forward momentum of our money growing.
Yep.
But what if we just had it in a bank B, right? That bank B is, hey, there's going to be a certain amount in there. We can borrow from it, but it's still going to grow as if we never touched it, right? So those are a couple of different reasons why the whole life itself is a great vehicle.
A lot of the people listening kind of know a bit about my story and understand what exactly I stand for. And we'll talk about infinite banking and things like that. But I actually had the latter part of that scenario that you mentioned, where it was like, I've got money sitting in the bank and I want it to be able to not only grow, right? So instead of losing to inflation, at least compete with inflation, but then also I wanted to be able to borrow from it tax-free, borrow from it myself. I just knew that there was a way to do it. And like you mentioned, Marvin Mitchell, he's somebody that I was listening to a lot on YouTube and just kind of getting an idea of, I had no idea what the concept was, hearing that the Rockefellers used it and all of these kind of titans of industry use this these policies in order to really preserve and grow their wealth. So that's why I get it, I got it. I'm just transparently speaking, I put 100K in and was able to borrow out, I think it was almost like 85+% of it or something along those lines. Tell us a little bit more, because this the most exciting part of this is that you can put cash into it, and then you were mentioning like 30, maybe 60 days after that point, you can borrow from it, but then it grows, it continues to grow as if you didn't even touch it. Like get us through that process.
It's weird because, well, how does that work? Well, it's a life insurance policy, right? In a way, the easiest way to think about it, you're borrowing from the policy, the insurance company still has that death benefit for collateral. So if you don't pay it back, that's just less your beneficiaries get. But like you were saying, the Rockefellers, I think the 401k has been around for 50, 60 years, right? Life insurance has been around for 100+ years, right? It's one of the first things, and there's a reason why it's been around for such a long time, right? People don't realize, well, 401k has been around because the government, like, hey, how can we get more taxes, right? It's such a great thing. It is and it's not, right? And I think with the life insurance, it's kind of what you hit on, right? You have money in the bank. Let's have that $1 used for us multiple times instead of dropping that savings. Now that money's not growing anymore, and we just lost that forward momentum of our money or the opportunity cost of that money. So I wish there was like some get really technical of like how that happens, but the easy answer is like that's how permanent life insurance policy should be set up. Yeah. Right. And that's another thing, right? It has to be set up the right way. And there's some people that want to set up and have more death benefit. Nothing wrong with that. There's other people in other instances, like you were saying, like yours is set up, right? Hey, I want the least amount of death benefit. I want the most money going to cash value growth, right? And you have to have a certain amount of death benefit to make sure that cash value growth is tax free. And that's what we're really good at, of making sure those policies are structured the right way, because that is very important when you're doing something like you want to do.
100%, because everybody's different. I'm in my early 30s. Some people may be in their late 30s, mid 40s, mid 50s, or closer to retirement age, and have different things that they want to prioritize. So obviously a conversation with you to be able to kind of determine exactly what their goals are and what their expectations are, and then make a good decision from that point. So on your end, in your like kind of point of view, what is your take on infinite banking, and like kind of like what is it, right? Does it actually work?
Yeah, good question. So for me, I have an index universal life. The easy way to think about that is when the market goes up, you go up. When the market goes down, you stay the same. So again, over the long term, last 20 years, average 6% growth, last 10 years, almost 7% growth. So over time, it's going to grow great, right? I'm about to have a kid. Great. Instead of getting debt for college, I'm going to take it from my policy, right? And then when it comes to retirement, it's long-term care. It's, hey, I can start taking tax-free income, doesn't affect Social Security, doesn't affect my taxes. And those are just a couple things, right? That's not saying, hey, if there's other investment opportunities, if there's debt I need to pay off, if there's a down payment on my house, you can use it for all that. The reason why we say infinite banking is, again, you're never stopping that forward momentum of your money. So even while you're using it for investments, everything like that, it's still going to continue to grow as if you never took it out. And eventually, it takes a couple of years, but eventually there's going to be more than what you put in. And then when you look 20, 30 years from now, it's doubled, tripled. That's just in the insurance policy. And whatever you do with that money, hopefully that's growing as well. So now you're using that same dollar multiple times. So we say infinite banking is because your bank has never stopped growing. So it grows infinitely even while you're using it.
And that's one of the things that was like most appealing to me. But the person has to be financially literate. They have to understand investing and what you're using that capital for. So it's not so much, or at least for the community that I have, it's not for you to put 100K in and borrow 50K in order to like go to Paris and go on a Caribbean cruise or whatever. It's do what you will. It's your capital. However, the best way to do it is to, or at least my opinion, my humble opinion, the best way is to, take, whatever out from the cash value and invest it, whether you put it into an index fund, whether you put it into a passive income opportunity, whether you purchase a property or what have you. Those those type of things are going to see your money like grow double and triple. And that's when it becomes such a compound effect, because you take from, and of course, this is just my opinion, right? And my strategy, but if you take from the policy, right, and you kind of divvy it out into a few different investments, right, you use that passive cash flow to either support your life or continue to kind of add more capital back into your policy, so you have more cash available in order to continue the cycle again.
And you're definitely right. You're definitely thinking about the right way. A couple of things I would add too is, again, this isn't necessarily taking money you don't have. We always want to make sure it's a comfortable amount, but again, for example, personally, I don't put more money in my savings account. I was happy where it is, so instead of putting money in the bank not growing for me, let me just put it in, again, this other bank that's going to work better. Now, to what you said is something else too. Like when we talk about credit card debt, that's 24%. Hey, if you can borrow money from your life insurance policy, pay off your credit card debt, you could say this has averaged 0%. Well, at least I'm not paying 20-something% interest on my credit card, right? So it's not just about the growth in the policy, it's stopping to pay high interest rates other places as well. So think about that, because everything you mentioned is spot on in terms of growing your money, but that's also how we can use it for other examples as well, where if you wanted to take that trip and put it on your credit card, that's fine. Let's pay off that credit card with a life insurance. And now, instead of, hey, I'm going to have to pay $12,000 on my $10,000, now we can just slowly put it back into the policy, and we've paid 2 or 3% over the course of X amount of time, right?
Yeah. No, that's amazing. For all those people that are looking to just leverage money to go on vacations, there you go. You just got the play there. So what is an IUL versus whole life? Can we talk about the differences there?
Good question. Good. Whole life isn't really based in the market, right? Is you're gonna get a fixed rate of return in any company we use, any company you use too. If you decide to go somebody else, that's fine, right? You want a highly rated company that's been around for a long time, whether IUL or whole life. Whole life, it's going to grow based on a fixed rate plus usually dividends that the company is going to pay out each year, right? So that's why I like to say it has a higher floor but a lower ceiling. You're going to average anywhere from about 3 to 5%. Not really going to be more than that, not really going to be less than that, right? There's no years you have 0%. Index universal life, it's not in the market, but it is based on the market, right? So we saw people last year, if you were in certain allocations, you might have gotten 0%. It might sound bad, but the market was down 15 to 20%, right? So again, we can never lose anything. There's other times you can make 8, 10, 12, 14% and all. Yeah. So it is more of a, hey, I still want to have some that's in an index allocation in the insurance policy. And when people want to talk about extra fees, I just think about there's not necessarily fees, it's just cost of the policy, it's cost of insurance, expenses in the policy. But over time, you pay about a 1% fee out of the 50 years, right? It averages to 1%. With that, it's going to get a lot more growth, right? A lot more opportunity. So I like the IUL more for growth. And retirement income, like I said, the whole life is more, and you can do both. That's the thing. You can do multiple policies. You can set them up however you want. I think that's what people need to realize too, is they're so flexible, right? You can say, hey, I want to pay in 10 years. I want to be done. That thing is going to continue to grow the rest of my life, even when I'm done paying into it. And that's with either type of policy. But those kind of the difference between the two is mainly how they're going to grow, what to expect.
Yeah, sure. So the IUL, and that's index universal life. Is that right?
Correct.
It's more so, it's not tied to the markets, but it is, or sorry, it's not based on the market, but it is kind of tied in some respect to it.
It's correlated.
It's correlated. Got it. It can go down a little bit to 0%, but in context, the markets may be down 10, 15+% versus on the higher end, it could be 8, 10, 12, 14% on a yearly basis, which if you're able to compound that type of percentage, you already can understand how much that can grow. And then a whole life is kind of more of the fixed kind of range, where it's not going to be too low at around 3%. It's not going to be too high at around 5 or so percent, which is more so in line with keeping up with inflation. Am I kind of right on that?
Yep, you nailed it.
So someone who would come to you and be looking for one of these policies, what is a typical scenario that you see that kind of makes cringe a little bit? And you're just like, oh man, like no judgment, right? But like, gosh, you could have a lot more protection in your life at this point.
I would say that's a good question. I just want people to understand too, like they sound great. What makes me cringe, to be completely candid, and this is part of people sometimes not knowing. So if this has happened, don't feel bad. You're like, wait, I thought I could borrow from the death benefit. I'm like, I wish you could put $1,000 in and borrow $500,000 right away, but that's not how this works, right? Or when there's companies out there that are all about term. I'm not talking about specific people, I'm talking about specific companies, and they're all about buy term and invest the difference because they want you in their AUM model, right? They want you in their investments, and they're going to charge you a fee for that. So they don't want to do the life insurance stuff.
Now, AUM,
assets under management, right? Sorry. So that's what makes me cringe. If someone comes to me, they have a bunch of term, I just want to make sure they have it for the right reason, right? Because again, if you need $2 million of death benefit, that's not going to cost as much in term as it will in a permanent policy, right? Permanent policy would be expensive, but over time, you want to start kind of doing it because your permanent policy is going to grow. So eventually, you want to have that permanent policy grow where you don't have as much term, or when the term ends, you say, hey, I don't need this term anymore because I have my permanent policies so much, right? And as we see with the older people, what really stinks is when someone comes to me and they just had a health situation, now they can't be insured. I actually had a personal situation of somebody when I was in my previous company, got a policy for him and his wife, right? We'd have coffee once or twice a year. And like literally a couple months ago, I found out she had breast cancer, right? Luckily, we had policies enforced for her because otherwise, and as far as I know, everything is good, but otherwise she wouldn't be able to get insurance for at least 5, if not 10 years, right? I think that's what people need to understand. So in that situation, I'm glad we at least had something on her because now she's uninsurable. So I think that's also too, is even if it's any type of policy, it's better to have something than nothing. And that's not work policies because you can't take those with you. So at least get something, and then you can always convert it, which by that is once you get your term, once you get a certain amount of death benefit, as long as it's with the right company, you can start converting some of that into a permanent policy without having to go through underwriting.
Okay, that makes total sense. So if I'm hearing you correctly, if you wait too long, right? If you wait until you're 60 years old, you may have a pre-existing condition or something that's precluding you from being able to qualify for one of these type of policies. And then not only will that affect your growth, but that also could affect your ability to be insured when it comes to healthcare and other matters like that. Is that
healthcare is different? But when it comes to life insurance, like I said, when you're in your 60s, if you don't have a policy yet, we do what a lot of people do is tax conversions, right? Taking pre-tax money, converting it to now tax-free, and we're able to fund the policies that way. But if you're uninsurable, we can do it on somebody else, right? We can do it on another loved one. We can do it on a kid, something like that, which is great, but you don't have that protection, right? When I talk about long-term care, the great thing is people sometimes get the wrong message with that. Well, what happens if I don't use it, you lose it.
Yeah.
But with this, either it's going to go to your beneficiaries or you're able to access that death benefit for long-term care. And people our age, I know we hear about it, it's so long away, but when you get to your 60s, or if you've had a family member go through it, you can just know how much of a burden or how much of a drain that can be financially too.
Yeah, no, I know. I'm going to ask you about term insurance, but one of the issues that I've seen with term insurance for myself, for my parents, my dad is 74 years old. He's got Parkinson's and he's outlived his term policy. So everybody is like, they get their 30-year term policy at 25 years old when they start their first corporate job or whatever. And at 55, 56 years old, that $30 a month that you were paying is now 150, and then the next year it's 300, and the next year it's 600, and the next year it's 1200, because they're like, you've outlived your policy, right? Like, hey, we can charge. There is no book on how much we can charge, or we are limited to charge you. So my dad was going from paying, I think it was like around $200 on average per year for the term of the loan, the term of the insurance policy. So now it's closer to like $2,000 a month for that same exact policy. And now my family has decided as of a few months ago to let that policy go because it no longer serves the purpose that they want. They're losing $2,000 per month, and he may live for another 10 years, right? And so now the value isn't there as much. So what are some of the benefits for having term insurance, and then what would you say are some of the kind of drawbacks, and then like what place does it have in the insurance industry for benefit purposes?
I think it's great, right? Because for me, I'm up there, right? If you have a house, if you have kids, if you need that, the good rule of thumb is to replace 20 years worth of income, or at least 10 years worth of income. It's not going to cost a lot to do that, right? With term. So that way, look, we don't know what's going to happen. That way we have ourselves covered, our families covered, our loved ones, but that should get us to almost retirement. Right? And that's the way to think about it, because 1 to 2% of terms actually pay out. So think about that, right? 1 to 2%.
1 to 2% of terms actually pay out?
Yep. Because exactly what you just said, right? Now, I'm not a big fan of 30-year terms. If you want to do it, I'm not going to stop you. I like 20 years. But hey, you're 55, great. Well, like you said, now the price is a lot more. So what if I get another 20-year term? Now I'm 75. Well, if that term runs out at 75 and I'm still here, I'm not getting another term at 75. Like most insurance companies won't even write it. They write it to 80. And at that point, in 2 or 3 years, you're going to be paying what the death benefit is, right? So that's where, again, I think younger in life, it's really a great way to make sure that if something happens to you, your family's covered. Other beware too of terms that say term to 90, term to 80. Yes, you have your term to 80, but that doesn't mean that when you hit 60 that it's going to start going up every single. People don't realize that because the first 10 to 20 years, it could be really cheap. But then every year, every 5 years, that thing's going to start jumping for you. And I've seen that where people like, well, I thought I was good. Or again, sometimes people, oh, well, this is going to last the rest of your life. And they immediately assume that's a whole life policy, but there's no cash value. That's really the way to tell. There's no cash value in it. It's not a permanent policy. And one other thing I would add is being term is umbrella insurance, not bad, but I would say get term from an insurance company, a life insurance company. Not naming other insurance companies out there, but here's my car, auto. Oh, and I have life insurance with them. That's great, but you might be paying a lot more. It might not have the same benefits. Where if you just went to a life insurance company, you're going to be able to get the same thing for usually a lot less or a lot better type of product.
100%. Yeah, no, it's definitely one of those things that I do believe, because I got a term policy as well. I do believe there's absolutely a place for it, but there's misconceptions. And one thing that you mentioned as well is like, you can't have a policy that costs $100 per month on the term side of things and then expect to be able to, oh, it's a 500K policy, I can borrow 100K out of it. So it's obviously it's cash value based, but also most term policies, at least the ones that I've been familiar with, they don't even allow you to draw from any of it. Yeah, no, that's all about a death benefit then. So term policy is all about a death benefit, whereas an IUL or a whole life policy has a lot of to do with the life benefit to take advantage of it while you're actually living. And it sounds like as well, when we talk about the differences between a 401k, and actually what would be great is what would be your take on a 401k versus an IUL or a whole life policy?
I think it's just like any other investment in terms of, I'm not telling you put all your money in an insurance policy, but also don't put all your money into the 401, right? And that's where a lot of times we find money. For example, if your company's matching 5%, first I would say put your 5% in the Roth 401k. You can. Again, we want to pay taxes on the seed, not on the harvest, right? Pay taxes now. You don't know what taxes are going to do. A lot of people think they're going to jump, right? So think about what they're going to be in 20 or 30 years. So get that match, that's free money. But if you're putting in 10%, they're matching 5, well, we could put that additional 5 into something like this, right? So again, it's just making sure you're well balanced. And when someone says, oh, I'm diversified, it shouldn't just be, I'm diversified in what mutual funds or stocks I have. It should be, what different types of vehicles do I have? Because again, you can't touch your 401k. And if you want to say you can take loans from it, okay, there's a certain amount you can take. You have to pay it back if you leave your job. So there's a lot of little things in there. With a life insurance, is pretty much cut and dry. Hey, I want to borrow X amount for my cash value. Couple business days later, it's in your account. You can do whatever you want with it.
Yeah, 100%. So it has pretty much a lot of the same benefits as a 401k, but a lot less of the detractors, which means like you basically can't take anything until you're, I think, 59 and a half, unless you're taxed at like, I don't know, like 40% or something crazy like that. Yeah, it's kind of limited. So a lot of people will do a split, like a match or whatever from their company, like so they only contribute up to the match, which that if I was still incorporated, if I was still in that structure, then that's what I would make sure to do. Not financial advice or anything like that, but I would definitely go into if my company had a 3% match, I would contribute up to that match to get those free dollars, so to speak. But like you mentioned, it's not like all or nothing, right? Either do a whole life or an IUL, or do a term, or do a 401k. It's in my opinion, what sounds like it may be your estimation as well, that it's good to have kind of a combination of all of them and just have a holistic plan for your future based off of what you want to see.
You nailed it, right? And that's really what it is, right? Having that whole holistic plan. So that way, because they all have their different advantages, and they all have, I want to say negatives about them, but they all have their disadvantages too.
Yeah. 100%. Anything else that you would want to add as far as a holistic view of the life insurance space, or anything else in terms of generational wealth accumulation and preservation?
Not really. I think we hit on a lot of it. And I would just like to say, when you, like kind of was saying earlier, you can have multiple policies. You can start one out for a certain amount, and then as the time goes on, you can get another one, right? So you can always have multiple of them. They're really, like I said, they're one of my favorite things to do. And the more I talk to people about, the more I can't believe I haven't heard this, right? And then you sit down and you show them, and it really is an incredible thing. But like you're saying too, Aaron, it's not, it shouldn't be the only thing you do. So I appreciate you letting me have, if you want to get in touch with me, you can, my email is m as in Mark Kaplan, Kaplan at crsretirement.com. And then you can also call me, the office 314-373-1598 and ask for me as well.
Love it. It's perfect. Cool. Well, I appreciate your time on this.